Futures Radio Show, sponsored by CME Group, the world's leading and most diverse futures and options exchange. CME Group's markets help individuals and businesses around the world effectively manage risk. For access to free educational tools and resources for the active individual trader, please visit activetrader.cmegroup.com.
Every day, traders and investors dive in to tackle the ever-changing markets to find opportunity. Futures Radio Show is your number one source for answers to the questions that all market participants want to ask. Veteran futures trader Anthony Crude sits down with the most influential leaders and top traders in the industry. Now, here's your host, Anthony Crude.
Hello, everyone, and welcome to the newest episode of Futures Radio Show, where we will highlight our favorite moments of the show over the past month. But before we get started, I want to thank all of our sponsors, CME Group, Trading Technologies, RJO Futures, and Top Step Trader. So without further ado, let's walk us through how your strategy works.
Yeah, so just kind of a big picture view of it is obviously I find out which side is in control. Okay, I like to look at market structure through a point and figure, through a kind of it's a delta profile point and figure. And the reason why I like the point and figure so much is because ES is a very rotational market, and that point and figure shows the rotational nature of that. And so I'm easily able to identify which side gets it wrong. So if I could sum up my process in just like one sentence, it would be to find out which side gets it wrong, and then I lean against those traders. So I just call them basically trap traders. You'll find very frequently you get heavy selling imbalances near lows or inflection points near the lows, whatnot, and then a high amount of buying volume and people getting long. When the market gets too long and it starts to rotate lower, then those longs up there are getting trapped, right? And so I like to identify those types of areas, and then I like to lean against those traders.
So you said you want to determine which side is in control. That's your first step, right?
That is, yeah, correct. Right. So if we're obviously in a super bullish market, or if we're in a super bearish market, which we obviously haven't seen in quite some time, I want to trade with that flow, because my thought process is, in the grand scheme of things, I'm a small trader, right? In the realm of who is trading the S&P futures, there's always larger traders, okay, that are trading the market. And so, I don't like to be swimming upstream. And I use that analogy quite often. Swimming upstream is not fun. It's not easy. And you're putting the odds against yourself. So I like to swim with the stream, with the flow.
How long does it take you in the morning to determine which side has control?
Yeah. So again, I to determine that, I go back to my point and figure. So I use a 20 or 25 tick point and figure, and that's kind of, again, I adjust it based off the recent volatility of the market, and that gives me a good idea of the price structure. So there are certain levels and certain areas at which, in my mind, one side loses some control. Okay. And so I determine what those areas, what those levels are. And if we're trading above those areas, then the buyers still have their edge.
Gotcha.
So I'm going to be leaning on the long side. Once those specific areas get taken out, then that shows me sellers are gaining an edge, and I want to start looking to trade with those sellers.
You've been at this for a while. You're on the right path. What's a piece of advice you could give traders to start getting on the right path?
Do you know what? From my experience, right, 99% will listen. They'll only learn or people only learn, and I'm talking about myself. I only learned once I made my own mistakes. I could tell everybody, you should, this is the mistakes I made, and you shouldn't do this. It goes in one ear, comes out the other, until they've internalized it by experiencing the losses and what they're doing isn't working for them. Now, for some people, it takes years. For some people, they're quick at grasping it. Say, okay, make the change quick. So, okay, I would give advice, and the advice would be, be very picky with your setups. It's okay, to miss a setup, stuff like that. Those are just general, stuff that anybody can tell you. But my experience is, okay, make the mistake. And I don't think we'll ever stop making mistakes, but I think with experience we make less of them, and the impact it has on our trading accounts is, it's less adverse. So yeah, I personally just say make your mistakes, and that's the only way people learn. And at the end of the day, right, everybody wants to be a trader, but not everybody can. I mean, the success rate is really low. But I think you have to, and it'll make, you have to be completely, like, for me anyway, I had to be obsessed while I was developing to come to the level I'm at now. Whereas some people just can do it quick. And the only way I'd learned was from my mistakes. And if somebody had told me you should do this, that, I wasn't really listening to them. I'd say, yeah, I had to respect, but I wasn't really going to listen. I was still going to do my own thing. And you'll find many days people are still doing the same thing, but not progressing. Because one, they're probably stubborn. And two, some people are just not willing to learn unless they make their own mistakes and realize for themselves, okay, now I'm going wrong. And once you accept that, okay, I need to change, that's when you'll only change. And that's when I think all the doors open. But like standard advice I would just give would be just be really patient. Patience, I think, and discipline is probably the biggest thing. Because once you've got your strategy, there's only so much you can really do in the markets when it comes to executing a trade. But the discipline and patience of waiting for it, I think that's a big battle in itself. As much as there'll be days where, like, I've got no trade, and then you start, ideas start coming to your head. I should do this. Oh, it's okay, I'll take a small one. But that, slowly can turn out to be a big problem. Whereas if you've been trading for a while, so you know what, I know what I'm doing, and that's only proven to you or internalized with your performance. Yeah, I've made a success out of it a couple of years, so I definitely know what I'm doing. So all I need to do is just stick to it. The trade opportunity will come one way or another. It'll eventually come. So what does that do? That you're not going to blow your account, and that's it.
Sam, talk to us about the fundamentals you're seeing right now in crude oil.
Fundamentals are looking good. We still see a lot of supply going out in the market because of the demand. Demand is holding very strong. We see Far East picking up a lot of oil still. And no matter what's going on with the trade wars, China is still importing a lot of oil. Saudi Arabia is exporting a record amount of it, which is closed July, and we saw 1.8 million barrels per day. That's a record for us. Back in June, we had something like 1.4 million barrels per day. So it's a significant jump. So even though Saudi Arabia has cut down its exports in general over the past month, they shipped a lot more to China as a result. So all this with the China trade war killing demand and so on, we don't see that happening. The fundamentals are, in fact, looking good for oil in that regard. Then we have the U.S. as well. We see big storage draws. But every time there's a tweet about China tariffs, and obviously that kills the whole sentiment of demand. And so that causes a drop in the barrel price. So which is, quite ironic, because you see big draws, but then you see a big drop in price as well.
I know that a lot of the traders listening are primarily technical, and they'll look at fundamentals for guidance, a theme as to what's happening in the crude oil market. What's the biggest story that's having an impact on crude oil that traders should be watching?
I think the biggest story right now is the fact that you have this whole issue of what's the accurate number out there in terms of what's being shipped. And I know that most of the countries that we all in the tanker tracking community cover, we're pretty much even Steven when it comes to the barrels that, for instance, Venezuela is shipping or Libya is shipping, etc. But then there are a couple of countries which we have complete big differences on. And one of them is Saudi Arabia, and the other one is Iran. Saudi Arabia may sound surprising, but they employ the similar kind of tactics as Iran does when it comes to cloaking some of their exports. Or in fact, if they're not cloaking it, they're actually delaying the data so that the vessel will depart empty, or at least look like it's empty, and then once it's near its destination, they'll update and say it's full. And that could take weeks for it to update. So in the case of Iran, they're cloaking most of their exports, almost, I would say, all. And but once they reach a certain place on the map, for instance, the Suez Canal or the Strait of Malacca, the Singapore Strait, they have to broadcast what they're actually holding. And so, yeah, we get a big discrepancy in regards to what's being shipped. And yeah, we're working our best to make sure that people are informed with the most accurate figures out there. And we employ techniques such as satellite imagery on a daily basis to see what's leaving the ports. We identify the vessels visually, and we can measure from their shadow depth as to how much content they have aboard.
Can you expand a little bit more and explain to everybody why the weekly charts are so important to you in your day trading, not just in your homework?
Yes, absolutely. Holding on to the larger, wider time frames, it keeps me out of trouble for these whipsaw tweets that cause crazy price action. Because at the end of the day, let's think about it this way. Big money can't move in and out all the time because there are too many transactional costs that they are going to have customers balk at and clients balk at if they see that amount of motion. Now, we do have high frequency trading and that pushes things around, but in general, big, deep pockets initiate into the market and then they hold the line steady and they say, all right, to whoever it is that's executing, hey, if it comes into this level on the low, this is where my risk is ideal. I want you to pick some up there. No matter what happens, just pick it up there. If it drops below, wait until it recovers, pick it up there. And so because I use these weekly and monthly charts, what I end up seeing is once I move away from initial support or resistance, any kind of whipsaw tweets that occur fall back into these value areas or spike up into the areas that are profit taking. And it has been really, it's like putting bumper guards around me. Now, granted, I miss some intraday motion that's very swift, but the one thing that it's done is keep me out of trouble and getting me in a drawdown situation that is uncomfortable to manage intraday.
Hey everybody, I want to take a moment to thank one of our sponsors, FTSE Russell. They are a leading global provider of benchmarks, analytics, and data solutions. The Russell 2000 Index is a key benchmark for small cap U.S. stocks. Be sure to check out the E-mini Russell 2000 Index Futures, contract symbol RTY. For more information on FTSE Russell and their products, please visit FTSERussell.com. You mentioned that the key is to set yourself up for success when it comes to defining discipline for you. What's your advice to those trying to put a plan in place and get some structure of discipline in trading in their life?
I think the easiest to put a plan in place is one step at a time, right? I mean, I think one step at a time in the sense, and I'll say it again, it's if you're not accountable to yourself, if you're not ready to be accountable to yourself and for yourself, then find somebody who can support you until you're able to do so. So with that, mentors and support system, they always have steps to support you, right? It's one step. So if it's waking up early, then wake up early. If you can't wake up early every day, Monday through Friday, then try it 3 days a week, 2 days a week, right? And so some people may say, oh, she's taking it too easy on the person. But really what I want an individual to feel is success. Because once they feel good about things, then they'll do it more and more and more. And as well as I know that is a snowball effect, right? You start to, if you sleep, you have a better sleep, you get up early, that starts your regimen. Then you choose better foods. Then you're more alert when you sit in front of the screens, right? Then you make better choices when you're in front of the screens. And then not only do you react with intent, but then you have the ability to respond with a clear head, right? And then you're able to be proud of whether it was a scratch day or maybe a small loss day or a win day. And if it's a win day, maybe it's a big win day. The market gave you a home run, or maybe it gave you a single, maybe a double, maybe a triple. And so it just builds from there. Right? It's just one small step in the right direction. If it's walking 10 minutes a day, then that's great. On the flip side, there are people who work out really hard every day, and actually what they need is to take a step back and really give themselves a break 1 day a week, maybe even 2 days a week. So, it's knowing yourself and then taking one small step, because we all know that one step leads to more steps towards success.
Another thing I want to talk about is holding a winner for a bigger move, or if something comes up just shy of the target, what do you do in that particular instance?
Yeah. Well, it's a great question. Like, how do you stay with the winning trade? And this just came out of my own development of just trying to be more consistent, right? Because there's no 100% setup in markets. Anybody who tells you that is likely selling you something. I mean, literally, they're probably trying to sell you something. But there are 4 questions that I found that I keep using to help define the trade. Because you think about how the brain works against you once you're in a trade. Like, even if you're wrong, the brain is trying to tell you that you're right. And I think Dani Sittloh has done some great work around behavioral alpha and talking about how the brain will start working against you and some of the biases once you're in the trade. So you have to define the trade before you put the trade on. So we use 4 questions every time before we put a trade on. And if a developing trader comes to us, this is where we start. We're like, look, you do not put a trade on until you can answer these 4 questions. The first is, well, what's the opportunity? Like, why this trade? What is it about this? And it could be like within profile language, there's something called a structure cleanup. So you could be looking to clean up structure. You could be looking to fade the IB. You're looking to go with the IB. You could be looking to take a second move on a binary event like an EIA, whatever the opportunity is there. But can you quantify it in terms of a price target? So let's start there, like a real objective target. Okay, from that, then the second question is, what am I willing to risk to go after that target? And then that's, like with the crude trade today, we saw a target that was about 25 cents. Okay, well, what am I willing to risk for that? And that was a reasonable target. Could we have gone more than that? Sure. But the reasonable target was about 25 cents. Okay, well, what am I willing to risk to get that 25 cents? That's the second question. Then the third question is, well, what would tell me that I'm right? Because, as traders, we're really storytellers. Like because we're making decisions on the right edge of the chart, we're creating a narrative of where we believe the story will go next. And certainly some are better storytellers than others. But when we're putting on a trade, we had in our mind what that story would look like. So, okay, let's articulate that. What should happen? What should not happen? Okay, if I'm looking for a trade to go directionally, what should I see? I should see more volume in the direction that I want to go. I should see any counter direction, like direction that's going against me, I want to see really weak. And I want to see it get slammed back away from me. That's the next part. And then the last question is, well, what would tell me that I'm wrong? Like, what should I not see? So like today when we were taking a fade trade, so you're fading a large move market. Well, what should I not see? I should not see the aggressive buying and people lifting the offer. I should see the weakening of the offer, which is great. I should not see volume spikes against me. Like I should see the divergence between price and value remain, because that was part of the key components of the trade. As long as that stuff all stays in place, you stay in the trade. And then as you're moving in the direction of the trade, then we use those smaller time frames to just help trail, to protect, as we get into the target. And then eventually we're using like OCOs, like, at the target and then a trail, just to protect against, some type of binary event, or in the world that we live in, maybe a tweet that can come in.
Can you give us a little bit more insight into the process and the details that went into creating the 30-year bond? I'm just wondering how you decided the tick size and, I really just everything that went into developing that contract.
Well, it really followed the Ginnie Mae, and that was the model for the design of the bond contract. Okay. We went through several iterations, should it be, 250,000, 500, what should be the size of the contract, and ultimately we designed it so that it would have similar movements in value to the physical commodities. And that was really the driver. Exchanges and competed with each other to keep margin requirements comparable, and you needed to have a contract whose size and margin were competitive enough with the grains and the metals to compete for the speculative dollar. It wasn't driven by the commercials, because the commercials always could trade a multiple. While that was $1 million round number at the point, the 100,000 was chosen to compete for speculative capital. We knew the dealers would trade and they could understand. The same with the tick size of a 30-second. It was basically patterned so that market makers could make money by buying a bid and selling an offer and make the tick as market makers. So you had to design the size of the contract, the method of delivery, as well as the tick size to compete with market makers and whatnot. So those were the design issues. We also set the hours so that they would open before the grain markets opened and close after, so we'd get people trailing into the pits to do that. We designed the cheapest to deliver because it followed the grain markets, and in terms of optionality, when you write or invent a futures contract, the requirement is that it gave whatever optionality there was to the seller, because the seller would ultimately control the supply. So the cheapest to deliver, the late deliveries, you put as much optionality in the contract for the seller to maximize their participation and their liquidity.
Hey everyone, I hope you're enjoying the show so far, but I want to pause and thank one of our sponsors, Trading Technologies. I started using TT in the year 2000, and I love it. It is by far the best trading platform I have ever used, and I've tried a lot of them. With TT, you can trade the global markets from virtually anywhere in the world. They are the world's fastest commercially available futures trading platform. I highly suggest you go try out TT, especially because you can try it for free. Just go to tryttnow.com and set up your account. A lot of what we discussed today was very high level and not for the beginning options traders. So for the futures traders out there that are interested in learning more about options or potentially even trading options, can you give us a few things that we should maybe pull up on our platform and keep an eye on? And also, because we as futures traders focus a lot on directional moves, can you give us a basic options trade example of how we can maybe trade a direction of the market using options?
So, good question. So, if once you kind of got yourself set up and you're looking at options, or you've got the capability, just keep things really simple around call spreads and put spreads. And that for me, their strategy is that you come from the futures space, so you're hardwired to be thinking about direction. Okay, so but what a lot of people will do, I'll give you an example of crude, is they would, let's say crude sells off $10 or something crazy, and volatility spikes up through the roof, and then people go, oh, I think it's going to go back up, but I don't want to buy it here because it has to kind of get hosed. I'll buy a call spread. So crude's come off, it's gone through 50, and he buys a 50-55 call spread. And whilst, that might cost X, but the moment he buys that 50-55 call spread, he's right. And directionally, crude goes back up. And that's fantastic because you're now getting paid for the long 50. But one of the problems that a lot of people come back and say, oh, I didn't make as much money as I thought, because when crude turns around, volatility will fade away. So at that moment in time when you bought that call spread, you were actually buying volatility at the top, because as you said, same with the S&P, as it falls off, everyone does the same thing. It comes off 100 handles, they all go and buy call spreads. Actually, something that's worth thinking about is if you're confident of the turn coming, i.e. we've bottomed, what you see a lot of institutions do is they sell in put spreads. It's still a limited risk strategy, but you're selling volatility at the high, and every day you're getting paid. And then the turn comes. Let's say you're wrong, the turn doesn't come, it carries on going, and you're still in a limited risk loss. But the turn comes, not only is volatility off, you're getting paid. So you tend to find that the retail guys think all the time of the direction of where they want to go. It's like they're flying an aircraft and they want to know where they want to land. A lot of institutions are quite happy to kind of look out the back window and just make sure there's nothing kind of chasing them. And that's if I was going to give a tip to somebody, that's to think that way around, rather than thinking always in the direction of travel. Think of the opposite direction of travel, but in a limited risk way.
Ira, I'm going to give you the last word today, and we've talked a lot about some of the things that you're focused on. We talked about the how Pax and I use your blog and other macro traders' blogs for execution and day trading. Going forward, what is a macro theme you think we as traders should be keeping an eye on?
Thanks, Anthony. And this is, I'm just sitting there and I'm discussing it with myself, which I always do. Here's what is important, because today an important piece came out this morning, and I knew it was going to gain some traction to be discussed, which was previous New York Fed President Bill Dudley had a piece talking about how the Fed should not enable Donald Trump's trade policies by continuing meeting them with lower interest rates. That's fine. That's fine. I have actually discussed this ad nauseum for 5 months, and talked about the trap that Donald Trump was laying for the Fed, which I believe it's a trap. And that's what basically Dudley says, is that they've walked into the trap, because Trump knows that if he wants to turn up the tariff rhetoric, it has a negative impact on equity markets. It makes financial markets nervous, and the Fed is forced to respond. Why else did they cut rates on July 31st? It was a response to Trump trapping him, and Trump wanted more. And then you got the speech from Jackson Hole. Trump wanted more. He didn't get it. Boom, the rhetoric gets turned up. This has been very consistent. So Dudley says, he advises, don't fall into the trap and stop cutting rates and stop enabling them. There's not a word of that I disagree with. But here's where I gained from this in reading what Dudley had to say. Not one mention of the dollar. And trust me, this is the final. Well, trust me. Don't trust me. Go do your work and read it yourself. Don't trust a word I say, because I'm here to dispel narratives. And anybody who reads my stuff knows that I build a lot on Epsilon theory, which is Ben Hunt's great work. That's far more difficult than my stuff to understand, but he talks about the importance of narrative. Well, to me, the narrative now going forward, I don't care what they're talking about on CNBC. I don't care, because that's a bunch of salespeople who meet and exact, and they're trying to, build customers. And it's all to that narrative, selling Wall Street. I don't care about it. What I care is if they're right, they're right. But in this venue, in Dudley's speech, not one word is mentioned about the dollar. So Trump's final effort to trap the Fed, because the Fed says, oh, we're not cutting rates. We're just going to sit here. You figure this out. Then the White House will ramp up the currency war. And I mean a legitimate currency war, not around the edges. They will start talking about ways to start depreciating the dollar. And don't forget, that's not a Federal Reserve mandate. That's under the authority of the Treasury, which is Mnuchin, who readers of my blog know the way I feel about Mnuchin. And it's been 2.5 years of constant banging that drum. But they have that power. And Bob Lighthizer, who's the mainstay of Trump's trade agenda and is a very tough negotiator and a very bright guy, and who was very involved in James Baker's Plaza Accord back in 1985, Bob Lighthizer knows how to use the tool of currency depreciation. People say, oh, they don't have enough strength. They don't have enough strength? I'll take you back to 1998 when Bob Rubin was Secretary of the Treasury, and they intervened on the yen in June of 1998 to drive the yen higher. The Treasury has a lot of power. And just the jawboning and the tweeting, we are going to get into some very, very, very powerful FX, foreign exchange. So this is going to become something to trade. I can't tell you exactly when it's going to happen, but it's on my radar screen. It's something I'm going to watch, and I'm going to look all around the edges for, to find when, in fact, it is really getting into play. So from this moment on, the only way I've been trading the currencies is really against the gold. As people have listened to us, Anthony, and certainly Pax knows the gold currency, and then my favorite was the gold Swiss. I'm not looking to buy dollars. I know a lot of people are bullish dollars, and they're going to tell you about the interest rate differential, which, listen, I'm a fundamental analyst who's been doing this for 42 years, and I understand that. But again, trading is a dynamic event. Markets are dynamic. If you operate with static lenses, you're going to get crushed. So now, is dynamicism going to change? I believe it's going to change, because Dudley's article just makes Trump that much capable of using that tool that he does control. And that can wreak all kinds of havoc upon the global system. So it's something that I'm going to be watching very closely, and I'm looking for it to gain traction in my trading narrative, and the one that I develop, because I think the dollar is now going to become a tool in Trump's hand. It's one thing to push the Fed. It's another thing to play with the dollar when he has control over it.
Great insight, Ira. Pax, we have a few minutes left. Any macro questions you have for Ira?
Yeah, Ira, how would is it possible that in a world starved for yield, and I mean a whole world, we have almost, as you mentioned earlier, every major developed country except for us, UK, and we don't have negative interest rates. So in a world starved for yield, is it possible that instead of equity markets, instead of the indices falling apart, that maybe the indices have a rally or at least stay steady, aren't as bearish as what I think they are?
Yes. And in that regard, I think that people who talk about the impact from the Trump trade barrage tweets that go on. That sort of affects it because, again, as Rick Santelli has talked about for so many years, Tina, there is an alternative. If people are willing to buy gold, they'll be willing to buy equities in the short term because, again, money's so cheap. And if you seek out some high-quality stocks, you find high-quality stocks. And as long as they're not carrying a lot of debt and they're paying dividends that are far above the 10-year U.S. Treasury note, and in Europe, of course, that doesn't even register because I'm looking at my list that I always keep in front of me. I have Portugal and Spain on 10-year debt paying basically 10 basis points. And then Ireland, Japan, Sweden, Belgium, France, Finland, Austria, Netherlands, Denmark, Germany, and Switzerland are all negative. Okay, so I don't even know what that means, but it means something, and it's setting people up for an absolute calamity there. So equities really are not a bad place. It's just that the geopolitical situation makes it very difficult. And of course, we're 14 months away from election in the United States. So all these things, are coming to the boil. And one of the things that I'm looking for, I'm thinking that Trump is going to put tariffs on the Europeans. I know they had a great love fest at the G7, but as I said to somebody, Trump and Macron were all lovey-dovey. But if I was Macron, I'd be very worried because every time Trump calls somebody his good friend and how wonderful he is, the next day he's putting tariffs on. Let's think about the effusive words he had for Xi, and we know what that turned out. So don't equate one with the other. In fact, it comes down to those who the gods seek to destroy, they first elevate to a higher level. So it's one of those things you have to remain careful about here. And so the equity markets, everybody says, well, Trump wants a strong equity market. I'm not sure what he wants. I didn't think he'd even want to be reelected, but evidently he wants to be reelected. But what plays out more, I don't know. I'm not sold, but the market left to its own devices in the world of such ridiculous, and I say that ridiculously low interest rates. It's what Ben Bernanke talked about in Jackson Hole in 2010, the portfolio balance channel, where you switch from less risky assets called bonds, sovereign bonds especially, into more risky assets, equities, and people have been rewarded. And is that ending now? It will end. It will end. What will really set it on fire? I don't know. But it will end. But right now, people come back to it because where else are you going with your money? Bitcoin? No, I don't think so. If you're in Asia and you're looking to move money, to move your to move out of your currency, Bitcoin is a legitimate alternative until it's not. So where do you go? And I'm telling you, it's much more rational to buy equities today than it is to buy bonds. I think bonds they're setting this market up for an absolute calamity. And people better start asking, who is it that owns all these bonds? If you think bonds are going up and yields are dropping because we're on the verge of a recession, I laugh at you. Because first of all, with the huge amount of deficit, with the huge amount of debt, like the U.S. debt is over $1 trillion, and we have a good economy. So if the economy slows, the debt is going to explode. Why should interest rates on sovereign debt go lower? I understand short-term rates going lower because the Fed can control that and push things. But why? Who would take these absurd low levels of return to take on all that risk? Not I, said the little red hen. Not me. I'm not doing it. And it's a very dangerous world. And so people better start asking, who is it that owns all these bonds? If you're not asking that question, and you manage people's money, and I'm talking about portfolio managers. I'm not talking about CTAs and people who manage trading money. I'm talking about people who manage investment money. If you're not asking who's buying these bonds and you're blindly buying TLT or whatever type of bond ETF that you buy, you better ask who is it that I'm in cahoots with buying these debt, because it makes zero sense to me. Zero. And I know that the curve is inverted, but I'm not buying the long end. I'll buy a 2-year, which has been okay, because people say, "Oh, you've been touting the 2-year versus the long." I said, "Yeah, I'm not saying you have to put the curve on, but that's what, with my own money, that's what I've been doing. I've been buying T-bills, which have yielded more. So yes, I'm not getting the capital appreciation, although if you bought 2-year treasuries, you did get some capital appreciation. So it really has not cost me all that much relative to the amount of risk that I deem that people are taking on. But that doesn't mean there's not, as again, let's bring it back to trading opportunities and the ability to seek some profit. And Anthony, as well as Pax, I don't care about your political philosophy. I don't care about your partisan stance. This is everything that we discuss is just the ability to try to increase and enhance our profits. That's all. I don't care one iota, and I don't want you to care one iota about what my political leanings are. Because if I'm really doing my job well, you shouldn't have any idea what those are. And I censor people who want to bring their politics into the blog. It's just not allowed. And Pax, you brought up a point before. But if you follow the discussions that take place on my blog, that I generate to get the discussions, you'll learn a lot more, because there are a lot of people who don't understand this. And all of a sudden, people who do and will express it better than I can are out there doing it. And you can really learn a tremendous amount. I learn from my readers. That's the beauty of everything I do. There's a guy, in fact, I'm having breakfast with him tomorrow, Mike Temple, who I didn't know literally from Adam, but he's been writing into the blog for years, and his comments are very good, and they're enlightening, and they offer trade opportunities. Here's a guy who's been long on a consistent rollover basis, the red euro dollars. That's been his trade. You know how well he's done with that trade for the last year and a half? Phenomenally.
I'm sorry to interrupt, Ira, but I've been reading. I read it. About a year ago is when I started to follow the red euros, and I haven't followed the red euros since I clerked in that part of the euro dollar.
Right.
Incredibly interesting.
Thank you for listening to Futures Radio Show. If you have any questions or comments for myself or my guests, please visit futuresradioshow.com and sign up to be a premium member for free. If you enjoyed the show, don't forget to leave us a review on iTunes.